Here we go. All right, Miguel. It's wonderful to have you on here. Thanks so much for hopping in. I know you're a busy character these days, so I really appreciate the time. I'm excited to dig in. Not only what you're doing at Capchase, but kind of the story that led you there. And you've done some fairly incredible things, but I'm sure there's some hard days involved with getting this thing off the ground. And so I'm excited to go through that and kind of give you a chance to tell the story here, buddy.
Same here, Sam. Happy to be here. Looking forward to it.
So tell me a little bit about coming up. You've done a lot of interesting roles, that kind of led you here. Is there anything, was it with Deloitte or, what was it that kind of, if you think back to kind of the start of the story, is there anything that comes to mind or really sticks out as like that kind of began, the path towards me starting this great company?
Yeah. So I've always wanted to build something, to build a company. And I was lucky that my mom runs her own company. My dad launched his own company. So I saw it kind of from since I was very, very small. So that's always the aspiration. And then, as you said, I went into consulting to pretty much learn about working. And then the problems that I was solving were really like very, very, very large corporate specific problems and things that didn't relate to what I wanted to do in the future. So I really wanted to get into tech, and I got into tech, into a SaaS company, which is where I learned most of what we're trying to solve right now. And I joined there as the first person in sales, employee number 9 or something like that, with 0 revenue, and left after 3 years after having run sales, success, and international. So I learned a ton there on what it is to get a startup from the ground, to find product market fit, to sell, to scale, organizational structures, and so on, and also a bunch of things to avoid, because we were learning a lot by trial and error. And then, the big thing that actually led to Capchase while that company was that, when we're running the sales and success teams and we're trying to get customers to sign up for the product, there was always one question that was always repeated in every single interaction, which was, how do we pay for this, right? Every customer wanted to pay monthly, and we needed the cash up front. We wouldn't allow them to pay monthly because then it meant that we, as a SaaS company with like a few million in the balance sheet, and that's all, we would be financing our customers. They would be paying monthly for something that cost us a lot of money up front. On the other hand, we want them to pay up front, but they didn't want to pay up front because then they would be financing us. So the only way that we had to incentivize them was giving them a large discount. So they would commit to a full year, they would pay up front, and we could get that money and reinvest it into more customers and be less dependent on our VC money. So that was kind of like the big pain that we started to solve at Capchase, and what took us, from 2020, which is when we started, to here.
Yeah, well, so the experience being in sales, it's having such a big impact there, I think, is really important because there are a few things as pure as being in sales, and so seeing the real challenges that businesses are facing, I think is you get a good taste of that for sure. Yeah. Would you say that being in sales was did you feel like you changed a lot or like learned a lot about being in business by going through sales, or is it something that kind of felt more or less natural to you? I'm curious, how the experience was for you. It seems to be different for different people.
Look, I'm so grateful that I did 3 years in sales. When I joined that company, I thought I was joining the strategy team, because if you looked at the sales, at the job description of like a sales development associate, I could tell you it was not very different from my job description as a strategy consultant. So I thought I was going to do strategy, and then I landed there, and they were like, "Hey, here's your phone, and you gotta cold call people." I've never wanted to do that. I've always hated cold calling people because I don't know, I would feel embarrassed or I didn't want to face rejection or whatever. And then after those 3 years, the things that you learn are invaluable, right? So you're always selling. I think in every single interaction, if you think about it, you're selling something, an idea, a plan, a job, a product. So then being actually forced to do it, because it's your job, I think it really grows thick skin, and it also helps you to really understand the other people's perspective, and then present a solution that it is a good solution for the perspective, for the problem, and then work together on the future. So I think it's an incredible skill that everybody should It really has it, because as you're little, you're negotiating, even with your parents and selling. But
negotiating with the parents, sure.
Yeah, no, it's true, right? But it actually practicing it and spending time perfecting it is a super important thing.
Yeah, I definitely spent a lot of time arguing with my mom, who was an attorney, so I can relate. So tell me, it seems like a fairly coherent, jump from those kinds of roles to starting a company that helps those SaaS, companies grow at a reasonable rate without, getting over diluted. You talk about non-dilutive capital, and so, how did you go about, what were the first steps in terms of, building this thing out? Were there some co-founders you went to, or, some early partners or investors you thought you want to talk to before really going full bore? Or is it, you just kind of jump in there, and like, I'm going to build this rain or shine type of thing? What did that early, days look like, maybe even before it became a real, company?
Yeah, absolutely. So it was a journey. So I think it took us 6 months or something until we actually hit on the idea. So I left that previous SaaS company, I think in like July 2019 or something like that. And then I was going to business school. I was going to HBS. So I was very lucky. And my goal was to get out of HBS, finish HBS and then launch my own company. I was expecting the usual, like this is going to be like a grind, after school when everybody's kind of like making money and stuff. I'm going to be working on my startup. So then I actually went to HBS with an idea that had nothing to do with Capchase. It was in fintech, but had not much to do with Capchase. And then we started looking. When we dipped when we dived deeper, in the idea, we started seeing complications. So then we would pivot, look at adjacent areas to learn more about it. We'd do like 2-week sprints, really, really going very, very deep in each of these ideas that we're looking at. And then we would either go deeper after the first 2 weeks or discard and move to something that we had learned in the meantime. So, after a while, one of my co-founders was at HBS as well, was a friend. We were researching on it. The other 2 co-founders had worked with me in the previous company and were also researching on similar topics. So what happened is that, early 2020, the idea that really resonated, which was like, oh my God, why didn't we think about this before? Because it would have solved all our problems in the past, was a tool for SaaS companies to sign up people that would commit to a full year and that would, pay up front, but give those customers the flexibility to pay monthly, right? So reducing the friction because everybody would get the best of both parts. The SaaS would get all the money up front, would get the annual commitment and would avoid discounts. And then the buyer would get the flexibility to pay monthly and thus, have working capital to use the SaaS product. So we started talking to founders and it really resonated. At the beginning, we weren't sure we were going to launch it because we were still in the discovery process, but people were loving it. And then what we were doing at the time was also applying to fintech companies for the summer, right? Because we didn't know if we were going to launch this or not. And we felt that we needed to learn more. And then what we started to see was really, really, really good reactions from founders and people saying like, oh my God, this tool, being able to offer flexible payment terms, but sign up people up front would be amazing. Like it will allow me to increase prices and reduce sales cycles. And in SaaS, usually anywhere that usually that's impossible. It's one or the other, usually one at the expense of the other, right? So they were very excited. And the next thing they were asking was if they could do the same thing, get all the cash up front, but give flexibility to customers to their existing customer base instead of to the new customers. So what we saw is that founders were really looking for an alternative way to get capital, to fund their growth that wasn't VC money. So then with that premise, we started talking to more customers. We signed up one customer and then we started to fundraise. But it was really organic. It was as a result of getting to the final round in a Harvard competition for startups, and then VCs starting to reach out, and then they started to build momentum. And once we raised our seed round, we're trying to combine both Capchase and school, and it got really, really hard. So we ended up dropping out to focus full time on the startup.
Yeah, that's wild. So the HBS dropout, I'm sure it's a well trodden path. But so as you start kind of building this out, when did it transition from those kind of arbitrage, for lack of a better word, going from annual to monthly subscription and kind of bridging that divide financially, because the discounts are huge, and on an annualized basis, it's you got a lot to play with on financially, as long as they kind of stick around. And so, what was the work like trying to figure out cancellation rates and getting a good estimate of that, not just from the businesses themselves, or like how did you guys tackle that problem?
Actually, being in the middle of a transaction and facilitating it, we thought it was going to be too complicated at the beginning. So we actually parked that and focused on turning existing customers into financing, because it felt like something that we could figure out easier. So we did it really, really early on. So we raised our round in July 2020, and then in August 2020, we started selling that product, and we had instant product market fit. We decided to invest a lot into risk and data really early on, because we were like, look, we can't afford to have a miss in the first few customers. We really need to nail this. And we're doing a lot of manual work. Just literally imagine investment banking work where you're manually building the operating model of these businesses and trying to understand what will happen with them in the future, to be able to see how much financing you could give them and how much money you would get back, because the easy thing in fintech is to give money and the hard thing is to get it back, right? So a lot of data crunching at the beginning, and then, with every iteration or every customer and every repayment, we started to learn more and more and started to automate more and more pieces of the underwriting and data analysis process. And now, after 2 years, we're the undisputable leader in the space by far. We're now getting into a tool where we're actually helping to close transactions, right? So the interesting thing is that with financing, every SaaS company, once they get to a certain stage, they can access cheaper cost of financing, like venture debt or banking, loans and so on. But they still have the same problem, right? They still have people that want to pay monthly and can't. And if they offer flexible payment terms, then they have the same exact problem. So now we're launching that tool. We're getting into the middle of a transaction and helping SaaS companies to close more deals that commit annually, and that they get the money upfront from, by extending flexible payment terms to their customers. So it's been like a journey where we decided to go down to tackle first like the biggest and most expensive pain that we could solve rapidly. And then as we learned more from SaaS companies who understood really well their performance and the uplift in the different metrics, if XYZ happened, then that's when we're getting into the payments and conversion tool.
Yeah. So tell me a little bit about, as you guys are building this out, you've got this team of folks that, help launch it with you from HVS, that's a great network. And then, you're bringing on, more team members. Your growth in headcount is phenomenal. Going from zero to, was it 140, 150 folks these days, something like that?
It's 120. We have 120. I don't know why we have a few people that just like say they're working at Capchase, but they're not. I don't know why, but yeah, there's like 120 in the company.
Yeah. Well, so you've got, that's quite a bit of growth. Tell me a little bit about, like, from the management side, what it's been like, kind of different, I'm sure, kind of like phases to your management. But, going from adding that first kind of team to having your first, like, real serious management issues with people that are, like, managing kind of more or less at scale now. Tell me a little bit about, like, what you've learned, managing people at a startup.
Man, it's brutal. I think it's the hardest thing by far. Because in the end, like, everything is about people and like emotions and relationships and so on, and trust, right? So how we started, we were 4 founders at the beginning. 2 of them were in Madrid and 2 of us were in Boston. So we were remote from the very beginning, and we started investing. Our first like 10 hires were only engineers and data scientists. So we decided to hire those in Europe for the talent to cost ratio being far superior than in the US, for an early stage company. So we started doing that. And then I think that when you really experience a big change in people management and structure and so on is when you get to like the 25 people barrier, 25, 30 people, because then like you just can no longer rely on organic communication being the main mode of people being up to date and being aligned on projects and so on. And you start working on parallel streams, and then you need to set up all these structures for data sharing, documentation, reporting, alignment, OKRs, and so on. And then after 30, it only gets linearly more complicated and not exponentially. But like there's a very, very big gap in my opinion from like 20 to 40. So yeah, like at that time, well, at that point, we had to start hiring for like more senior people. And the largest org being in tech, we started with that, with a VP of tech coming from previous startups, from almost a decade at Google. And that person brought an incredible expertise in management. I think that what those very big tech companies do really well is management training and really excellence in everything around management. So finding the right talent, having the right processes to find them, to interview, to nurture them, to performance manage them, to promote them, and so on. And we learned a lot from there. And we've had a lot of discussions, conversations, and so on. And now, one thing that we do once we're like much larger and we have like a senior team, we have a staff team, and so on, what we do is really put in practice. This practice is called, I'm not sure if you read The 5 Dysfunctions of a Team, but basically it's a book from a guy called Patrick Lencioni, which is all about organizational health. And there's a very big emphasis in building trust that will allow you to have competing opinions and discussions, and then get people to commit to whatever is decided after very hard discussions, and then hold each other accountable to that. So it's been a journey, and I think we're still improving. Every time we do like planning and OKRs and stuff, we always find learnings for the future. But it's also really, really cool to see how things are getting into place, and things that felt noisy and chaotic now are streamlined and work nicely. So it's brutal, as I said at the beginning, but it's a nice process.
Yeah, I mean, I don't know how philosophical you want to get, but I feel like a big part of it is, of life, and especially in startups, is like slowly turning chaos into order. I mean, and I think the hardest probably part of that is working with your team. So it's great to see. I think you're right. That 25, 30 folks where it's like you can't know what's going on anymore, and so you got to really think carefully about systems. Tell me a little bit about the early days of funding, right? So you're a startup yourself, so I'm sure you're out there with funding. You have some wonderful investors. How did you think about that together with the fact that you also need to raise funds for your clients? And so there's obviously you're not the ideal risk profile of like someone to manage money, being a startup. And so how did you go about tackling that particularly thorny issue?
Right. So yeah, we needed to raise a ton of financing to be able to give financing to our customers. And we're going to make, very small returns on the financing that we give to our customers. We couldn't do that with very high cost of capital. So with VC money. So we needed to always be thinking about raising VC money and raising debt in different forms to be able to finance our customers. So the easiest way, of course, to start is with VC, at least in our case, because VC investors, if they come in early, they see unlimited returns and then very limited downside, right? And then we didn't really want to lend VC money. So we went and raised debt from family offices and high net worth individuals. That was covered by the equity, so we weren't really over leveraging ourselves, but will allow us to go much longer. And we started raising credit facilities from day zero. And credit facilities are a beast, right? The first one took us like maybe 4 months from beginning to end to close. And why I say they're a beast is because they have, warehouse facility investors or credit funds have limited downside. They have the same downside than a VC, right? Like they could lose 1x the money, but if everything goes well, they're only making, teens returns, right? So what they do is they're really focused on avoiding losing any of the principal, right? Ideally, they don't want to go below 1x in their returns. So then what they do is they actually underwrite the company and underwriting your ability to underwrite other businesses, and then a lot of stress testing about about our underwriting model and about our ability to collect and all the bells and whistles that we have, to avoid fraud and to avoid defaults and so on. So that process is really long, really structured, heavy due diligence, lots of calls, lots of negotiations. You end up negotiating on like 20, 30 different things. Because as an early stage company, you want a lot of flexibility to be able to experiment with different product configurations and with different customer types. But that has a price. Because if you want to experiment a lot, then you're going to get like crappy performance. You're going to have to pay a lot to your lender. So it's a very delicate balance. And then once you do that, then you can scale much more efficiently. And if you prove good performance, then your terms keep getting cheaper and better, right? Like your lenders will be able to advance more cents on every dollar that you give out, and your equity goes for much, much, much longer. And then what happens is that you start going down different steps of capital where you're getting less flexible and you're getting a more defined credit box, which is where you've shown really, really good performance. And in exchange of that very tight eligibility, you get a better cost of capital and a better advance rate, which means again like that you're using less of your equity to do that. And eventually, on the debt side, you go to the public markets, you securitize, and then you can access very low cost of capital and in a very rigid structure. So for us, it's always been like almost like a relay race of raising equity, raising debt, raising more equity, raising more debt, and larger amounts. And now to date, we've raised almost $1 billion in equity and in different credit facilities in different shapes and forms and geographies. So yeah, very different processes, very different skill sets. And in fact, the debt is mostly run by capital markets because they're experts at it. And the equity is Michael Fernandez Larrea.
Yeah. What was it like, building out that team? I assume that there were some like early, key hires that were kind of taking, the what you guys were able to do over just kind of like force of will, and kind of be, professionalized, the capital markets team, which is the full articulation of that. How'd you go about building that out and making that, less of your daily work? What was the progression in terms of like the people and what they were working on and the strategy? And it sounds like you got quite a bit of flexibility on the different, securitization of the debt. And so it sounds like you guys are kind of open-minded about how you raised it. So tell me a little bit about like how the team and progressed and how you guys approach those markets at different points.
Yeah. So the good thing, is that we didn't really know that much about the space. So we did things that other people considered impossible in terms of the speed at which we did it, right? So that was awesome. At the beginning, we found an advisor that helped us to raise the first credit facility. And they helped us mostly with the structuring, with the conversations, with the negotiations that I mentioned, are like really, really, really detailed. And then helping us know, what's market, what's not market, how, what to trade, or like what trade-offs to make. And then once we got the first credit facility going, the strain went from negotiating and sourcing that capital to actually structuring the data so that there was almost like a zero error policy, where you don't want to send any data that's not perfectly right to your creditors, because that's what makes them freak out. They're like, oh my God, these guys don't even know the data. How am I going to trust them, with capital? If they don't even know, if they can't even track of what's happening. And you'd be surprised about like how detailed it needs to be, like to the cent. For example, with FX, right, when we were originating in the US and lending to a company in London, we didn't want to either bear the FX risk ourselves or to, have our customers bear the FX risk. So what we would do is we would hedge those trades, right? So we would do a spot change from USD to sterling today on day zero, when the customer would take the money, and then we would put 12 future trades in the future. Well, we would hedge 12 future trades, so that when the customer paid back, we would still do it at the same FX change of today, even if it was in 1 month, in 2 months, in 3 months, and 12 months, right? So these are like some characteristics, whatever. Sometimes there would be a change, of like cents, literally 2 or 3 cents, imagine in a $200,000 loan. And then if that data is wrong by 2 or 3 cents, then your creditor is going to say that you're a default, or like that's, like the customer is delinquent because they haven't paid the right amount that they should be paying. So anyways, like the amount of technology we have had to develop to be able to reconcile all of that, keep track of all of that, the changes, reflects to underwriting, build all the rules and so on, is huge. And now, in fact, there are a lot of financial institutions that want to use that technology because nobody has ever done it before for for SaaS and technology businesses. So, like the thing is that you start seeing that what you invest in to solve some of your pains actually becomes valuable for third parties, which is something similar to what happened with AWS back in the days,
Sure. Yeah. So tell me about, building that out from, more or less a minimum viable product, if you will, to something that, is tuned up enough to where, banks are interested in how you're doing this. What was it like, the technical journey like? I think you started out with, pulling, just their data, building models, more or less from scratch. And, now you're kind of got, the sexy integration, with Stripe or their banking or whatever it is, and kind of able to see what their data looks like. What was that progression? Do you remember any like kind of key inflection points on any of that?
Yeah, I think that, we started with the integrations with the systems relatively early on, right? So we started with Plaid because it was almost like off the shelf and companies could just connect the banking data and we extract all the data. And then we built the payment platforms integrations. So Stripe, ChargeBee, Recurly, Profitwell, and so on. And then last of all, the accounting integrations. So at the beginning, it was all just front end and with the integrations built in, and then we would extract those integrations in Excel and we'd have to build the models manually. And then we'd keep everything in spreadsheets, the forecast, the stress tests, the loan tapes, the transactions, the expected amounts, everything. And we'd track, our metrics in spreadsheets. And then what we started to do was start to automate all the underwriting process. So we invested a lot in the data pipelines to turn all the unstructured data into specific operating models for companies based on, their very granular payment metrics. And then we started to facilitate things for our underwriters, right? So we started to recognize patterns to suggest which metrics to evaluate, which metrics to stress test, and so on. And then we started to integrate the underwriting outputs with the front end to present specific deals to customers, with the back end to present to creditors. So we start building like an ecosystem that goes end to end from data ingestion to almost like return payments automation. And that ended up becoming the platform upon which we're building all the systems or different systems to serve different pains from our SaaS customers. So our goal was always to use lending as a wedge to then build a platform that could automate kind of like the whole experience of buying and selling a SaaS product. And that's what we're able to do now based out of that very solid infrastructure, of which lending is only one part,
Yeah. Well, you've got a killer strategy for sure. So, tell me a little bit about like the regulatory side of, lending money. Obviously you're dealing with a lot of banks and they, want to make sure you're up to snuff on the regulatory side. What has that experience been like? What has been most surprising for you setting up, a lending shop in terms of the regulations that you're dealing with, and what has been kind of like most onerous that maybe wasn't as expected as some of the other stuff?
Yeah. So to be honest, that part we've had it really, really well covered since the beginning. We've got our California lenders license just in case, although we've never had to actually use it because of the characteristic of our product. But the reality is that, being B2B, there's less emphasis on being regulated because the regulators assume a specific sophistication on the other side, right? Being a business is not like a consumer where like maybe they don't really understand finance that well. So you need to be extremely clear and you can be, you need to take care of usury and so on. So, like there are some basic things, like maximum interest rates that you can charge, what happens if a company can't make payments back and what the process looks like, etc., that you have to comply with. And like, there's no way around it. And if you don't do it, you will get caught, at a certain scale. So we decided to comply with that from the very beginning. But there has been some regulation complexity, specifically in international markets, right? So the US has some variations from state to state. But then you go to Europe, for example, the UK is very similar to the US. Spain and Netherlands are less regulated on the B2B financing side Germany and France are crazy in terms of regulation complexity. So you have to use a partner bank to originate. The Nordics are a mix. So being able to give the same experience to every customer, regardless of where they are, and being able to manage all the regulatory, currency complexity in the back end has been also like a technological challenge and driven by our tech team.
Yeah. How did you, the product of lending is kind of special in that folks tend to want as much as they can possibly get at, type of thing. But what was it like, going out and acquiring these clients from the early days? How did you think about, at least like high grading them for the, having the best ones, kind of float to the top that you're working with? How did you think about like client acquisition in those early days, and how has that progressed for you guys?
Yeah. So you think about it, right? In lending, right? The easy thing is to give out money, right? Everybody wants money, and usually the people that want the money the most are the ones who want to lend money the least, right? So you can't really rely that much on inbound from people that want money, because then you will start getting a lot of people desperate for money, right? So you need to be able to have the discipline to evaluate companies and understand, first of all, the metrics, and then what they want the money for, and then help them to understand what is the right amount, and help. In our case, we want to help them minimize the cost of the paying, right? So instead of encouraging them to get as much money as possible, what we want is for them to feel comfortable that they can access more money, but to take smaller amounts that are easier to digest, than a big lump that's just going to sit in the balance sheet, costing money without generating any returns. So back to where we found customers, at the beginning, TechCrunch put us on the map with our press release for our seed stage funding, and then we set up a sales team very, very similar to a SaaS motion, where we have SDRs, we have account executives, and we have a very, very strong team of customer success, which we call growth advisors, that really help customers on everything related to their growth, not just financing, but everything. How they should do pricing, and how they should account for things, and when to file taxes, because what we want is for them to see us as a trusted partner and not just as a lender. And then, we uncover a bunch of pains through that they're working on solving. So in that sense, I would say that right now our mix of channels is a lot of organic, so mostly PR and our content and our guides and so on. A bunch of referrals, both from existing customers and from VCs and partners, and then strategic partnerships, which are the Stripe of the world, Mercury and so on, that we're integrated with. And last of all, outbound and the usual email marketing driven by SDRs.
Yeah. So that sounds about right for the modern go-to-market. So what has been kind of the experience now has been, in the lending world, but you've kind of expanded, I think with the tech stack beyond, in your capabilities, but, going to the next 3 years, you've only been around, for a little while and achieved an incredible story so far. But what are you guys excited about, going forward, or specifically you're excited about going in the next 3 years?
I'm extremely excited about everything that's coming next. On the one hand, I think that this market has made, I'm really excited about everything, about our current product, about the product that we're launching, and then about the future and the ecosystem and the space, right? So let me start with the market first. Right now, as you know, equity is either non-existent or extremely expensive, which means that founders are looking for alternatives. And every founder raised last year at very high multiples now needs to show up, in growth, everything that they lost in multiple compression, right? So if you raised, at 20x multiples, and now you can only raise at 10x multiples, then you need to grow twice as fast because your multiples are half, right? So founders are looking for ways to do that, right? How can I grow into something? You need to grow basically faster, which means you need more capital, but you can't really find capital from VCs. So you need to look for something else, right? So we're seeing a lot of demand because we are that something else that helps founders to scale faster. And that's awesome. And then we were very, very disciplined from the very beginning with data, which means that right now a lot of our competitors are actually trying to figure out, how they're going to adjust, how they're going to set up the proper controls. So like we have a very dominant position right now. And then with respect to our new products, right now we've learned so much over the last 2 years that we are ready to launch this new product that solve additional pains for our customers and that enable us to go way further up market. So to give you an idea, those are, this kind of like transaction enablement product to help with conversion. And the other one is the banking infra thing that I mentioned, where we're selling an infrastructure that we developed to financial institutions. So what this is doing is that, as before, customers would reach a certain size and then they would go to something else. With these products, we can work with those customers in two ways. One, enabling financial institutions to serve them with our technology so that the user experience is very similar. They have the same, positives of scalability, availability, speed, and so on. At the same time, they have a cheaper cost of capital because larger banks and so on have better cost of capital than us. And then the second product that enables them to sell more by giving flexibility to their customers is something that remains a pain from day zero to day N. Salesforce has that problem where they wish, they have to offer flexible payment terms to get more people to sign up, but it's a massive pain and it kind of like messes up a little bit in economics. So for example, if our cap with a current product was 20 million ARR, with this new product, we have customers with 500 million ARR, with 700 million ARR. So it enables us to go way further up market. And it enables a host of adjacent products that can solve more and more pains on the transaction side of a SaaS product. So as you can see, I'm just very, very excited about everything that's coming up because we have a very dominant position and a whole world of opportunities ahead of us.
Yeah, that's very exciting. So, typically when I like to ask folks, on the back end here, my favorite last question is, you've had this fairly fascinating story and it's, an enormous amount of success pretty quickly with what you put together here. But if there's something that now that you wish you knew when you're first getting started, what would you go back and tell yourself to make it a little bit of an easier ride?
Yeah. I think that probably to never lower the bar. We always try to say that we're always raising the bar, but it's true that, when you're like in hyper growth and you need to just find a ton of people to solve problems and you start onboarding, 10, 15 people a month, then you inevitably lower the bar, especially, last year where the tech world was crazy and the valuations were crazy. So people had a lot of money. So people were sending crazy offers. It meant that every single candidate had a few offers and you need to somehow just like go for it. Lowering the bar is never good. Like just don't solve problems throwing people at it. And then adding more people that are not excellent to the company just increases complexity. It demotivates the performers and then you just add pain because you end up having to part with them. So if I could make like an iron rule of like, you will never break this, would be never, never, never lower the bar, even if it takes longer to hire somebody, You can always sleep less for a while and then find the right person, then actually find the wrong person and then you don't sleep for much longer because you're worried about that person like not being up to expectations and kind of like polluting everything else. So never, ever lower the bar.
Yeah, well said. Retaining quality while growing. I think that I'm sure it's been tough, but you seem to put together a pretty strong team and dominate a very new and interesting market in a fairly short order. So Miguel, it's been wonderful to have you on. Thanks so much for stopping by the pod, and I wish you everything the best going forward. I think you guys are geared for a very exciting next few years here.